Hello, everybody. Thank you for joining us for today's webinar, Thoughts and Reflections on the S&P 5000 level. Good morning, Jim.
Good morning. Good morning. Okay, do a very, very short commercial. I'm going to do a longer one later. As you know, if you've been with us before, we do these free programs in order to draw attention to our educational programs. The next educational program we have coming up starts on February 21st, and that's our big program, which is the intensive. The intensive has a prerequisite to it. You have to have completed the foundational e-course or have attended a prior intensive. There will be a substantial number of people that say they've read the books and they don't need that. And the answer is no, the requirement is firm. Other people just don't teach it the same way I do. And there's been tremendous changes since the books were written many years ago. All right. But let me come back and let's talk about today. First of all, I want to make a comment. When I do the YouTube over the weekend, we do a commentary on the over the weekend called The Week Ahead, and we're just giving you some orientation for Monday morning. And there's a tremendous misunderstanding. Most people are very comfortable with what we do, but there's always a few that really don't understand what that says. For example, I have said for some time that the underlying structure of the market is very poor. And I continue to say that. At the same time, I talk about the fact, do not fade with the trend. As short-term daytime frame traders, trade with the trend. The first time that I encountered what we're talking about right here, keep in mind, I'm going to be 84 this summer. And the first time that is visible in my mind was the early 70s, when we had what was called the Nifty 50. The short-term traders got control of the market. Momentum was driving the market, and the market went exceptionally high, and it got to the point it kept thinning out what was driving the market. It got near the end, about the only stock holding the market up was IBM. And of course, then we had a tremendous break in the market following that. The next time that is clear in my mind, I'm talking about my early days, was 1987. In 1987, the market went up very similar to what it's doing now. It's just momentum traders taking the market higher day after day after day. And when the break finally came, it was so dramatic that it theoretically shouldn't happen in 2 lifetimes of the world. Now, the recovery was very, very high and very swift. But what happens in here is that, when these markets get in these modes, traders do what works until it doesn't work anymore. And it's not illogical that they just keep taking the market higher. And it's one thing to recognize that the foundation is weak, and it's another thing to recognize that the momentum's going up and you don't fight momentum. So again, a lot of people don't understand that. The current market is doing things similar to what I have seen in the past. The momentum is taking the market higher. You don't fight momentum. Okay, now, the next thing that we've talked about before, and that is that the longer term investment money or the longer term traders, when you get up near the all-time high, so that magical 5,000 level, smarter money looks at risk return a little differently, and they understand that new high level, that 5,000 level, that is a go, no-go level. So from a risk standpoint, the larger, smarter trading money, I mean bigger trading money, they will exit the market on this side of 5,000. And then if the market reestablishes itself above 5,000, they will come back in. And what they understand is this is the high risk area. So they understand they'll get out where it's high risk, and if it reestablishes a new leg to the upside, they will come back in. A lot of people really don't understand the dynamics of what goes on there. So now we're at the 5,000 level. So this morning, the market, the NASDAQ got up there yesterday. We were just touching it on the ES, and then the market, didn't get it on the close. So overnight, the market snuck up there again. And then a little while ago, you got I think it's a reevaluation or an adjustment, seasonal adjustment to CPI, and it showed that inflation was even less than originally reported. Well, you got an immediate spike in interest rates, where the rates immediately went down temporarily, and you got a spike in the ES, or the S&Ps. That was just a short-term spike. Now, we don't know the outcome. As we get ready to open here, we've got about 20 minutes until we open. So the first thing is we are looking at a gap. And the gap trading guidelines are applicable again this morning. The gap trading guidelines are go with any gap. And remember, we look at gaps differently than the traditional technical analysis. We look at gaps relative to the previous day's high. We do not look at gaps relative to the settle. We look at relative to the previous day's high or relative to the previous day's low. When we look at a gap, we want to make sure that there's really some significant difference being demonstrated in the market. So that's the first thing that we'll be looking at when the market opens this morning, is the gap trading guidelines. If the gap is filled, if the gap's not filled, well, the best buying opportunity on an upward gap was when the market attempts to sell off, tempo or pace slows, volume slows, and at that point in time, you come into the buy side of the market. If the gap is to be filled, usually the selling takes place fairly early. The market then re-enters yesterday's range to fill the gap. Then we monitor for continuation. And the first thing for monitoring for continuation would be to see if value at a minimum can develop to at least unchanged. Now, if you look what's in front of me, very questionable. This is a P shape, which is like short covering. It's old business, not a combination of old business and new business. The overnight low was exactly at half back. Okay, that is not a sign of strength when it's coming from an exact reference. We look at last night or yesterday, there's no real excess on the low yesterday, even though I keep these in twos. And look at the overnight low. The overnight low, this white line, is at half back from yesterday. That is not strong buying. Okay, so everything's a series of facts, but you have to keep other factors in mind. So what we're dealing with right now is, do we have an upside breakout relative to the 5,000 level, or do we have an upside breakout failure? And we'll just have to see what happens this morning. Jen, let me take 2 or 3 questions, then we'll do a commercial, then we'll come back to the market.
Okay.
Jen,
Does this logic apply to other major references like the 200-day SMA?
Yeah, I think so. It can apply to any any major, the more significant the reference, the greater the odds that that will occur. And I think the 200 is where I would start on the, looking for what the larger trading money is doing. Okay.
Okay, and another question here. My question is, how can a person like me better differentiate price fakeouts from market turns?
That's a question that's, asked by somebody that really hasn't gotten a lot of experience in the market. Obviously, that's everybody's question. And you never know the answer to that question. That's why you have to be able to monitor what is going on in the market right now in the current sense. If if, for example, the market has looked overnight above the 5,000 level, okay? So if the market, and we're gapping higher, if the market can't close the gap this morning, well, at least for right now, you have upside continuation. If you close the gap and then you get unchanged or unchanged to lower value, then the upside breakout failed. Okay, what else?
Okay, on a broader note, has Jim noticed how the SPX and NDX are rallying, but small caps Russell is stuck in a range? I'm curious if he has thoughts on that.
Oh, absolutely. You've got the small cap, those smaller companies, they are so much more dependent on interest rates. And of course, the interest rates, have risen again. And that hurts the small cap. That doesn't have the same effect on, on the larger companies. So, and that's always been the case. And we used to say higher rates were, historically, higher rates put more pressure on the the big tech stocks that were, high multiples and always dependent upon forward earnings in order to justify their price. But this whole AI thing has kind of changed that background in the investor's mind, at least for right now. Okay, Jen, let's do a commercial, and I'm gonna I'll give a brief introduction, and then Jen will walk you through what's coming up here. First of all,
I have it on my screen, our website. Do you see it, Jim? I just want to make
yes,
sure.
yeah,
Okay.
thank you. Okay, the intensive coming up, I think, is going to be the best we've ever done. People were very complimentary of the last one, but what makes this one different is I'm doing something I never thought I would do again. I'm writing a new book. It's a legacy book. It updates the prior two. Don't get excited. It's probably a year away by the time it goes through the publisher and they do the editing and the marketing and all of that kind of stuff. But and I've written 17 chapters so far, but what is important, it makes me go back through and reevaluate everything I've talked about, everything I've seen over the years. So in a sense, that freshens things up quite a bit, and it's easy to get stale. Okay, so that intensive will start. I think it's February 21st. Remember, there is a prerequisite. You have to have completed the foundational e-course or have been in a prior intensive. Jen, let's do a fast commercial, and then I'll come back and we'll do market stuff.
Sure. For those of you that are new, our website is jimdaltontrading.com. The week ahead video on YouTube that we release every weekend, you can find the link to our official channel right here. Please like and subscribe if you like that free content that we post there. Our X, we should really update this icon account here. Watch out for a lot of people that imitate us, take Jim's tweets, etc., replicates them with images, and then they try to advertise to you. We do not do that. So just want to point that out so that nobody falls to any scams or anything like that. But you go to courses at the top, navigation, and you'll see that the intensive is featured up there. We have the schedule here so that you can see our special presentations and kind of like what the schedule is like, because we have multiple webinars every day with the exception of Fridays, so that you can download that. Jim spoke about the prerequisite requirement, which is the foundation and application of the market profile e-course. You can find that right here. I know that somebody wrote a question and just said, do you just sell the e-course alone? Yes. Right now we've got the limited time discounted bundles for purchasing more than one course available till basically only a few more days, till February 11th. And the reason why that is because we know that there may not really be enough time for you to finish the prerequisite requirement before the course starts on February 21st. So if you're looking to do the foundation e-course and you want to do the intensive, you're going to want this bundle right here that you can get a discount for purchasing more than one course. If you have any questions, by all means, you can shoot us an email, Dalton at Jim Dalton Trading down here at the bottom of our website, or give a call, and I'd be happy to speak with you and answer any questions that you may have. But the prerequisite requirement is a requirement. There's no way to bypass it unless you have done a full intensive with us in the past, and we can verify that, or you've already completed the foundation e-course previously. Okay.
Okay, thank you.
Okay. Let me give you
Let's
the
go back to
screen
market.
back, Jim.
Okay, and give me some market questions.
Oh, and the other thing that I just always want to reiterate, because it's asked of me all the time, are the webinars recorded? Yes, they are. The material from the intensive is all recorded, and you will have access to material for 1 year after the course finishes, so that you can review that material, or, in case you work a day job, you're not able to attend every webinar live, completely understandable, or you have a down day, something like that. Okay. Questions. If a counter trend break develops, what downside levels are you looking at?
You don't, you take it, you monitor for continuation. And let me give you an example of that. Let me just show you something that I'm gonna pull up this day 2/5. And here, when you talk about monitoring for continuation, on the 5th, the market started down early. A period, B period, C period. Notice how stretched out B period is. And then the market comes down. And if you're just following price, you can get all excited about this because it's moving very quickly. Notice it did not take out the previous day's low. Okay, so when you talk about levels to monitor, you're doing it one step at a time. So this breaks pretty sharp. First of all, this was very stretched out, which always increases the odds it's going to be retraced. When you come down here, and I mean, this took your breath away how fast price was falling. But a lot of times that's what happens when you're getting liquidation. But then you're looking down here and you see it's an inside day. You didn't get out the low from the previous day. The trend is still in place. So this is the kind of thing that you have to do. So if the market starts to break, you're going to be looking at yesterday's low. You're going to come back and you're going to just, you've got a big breakout here. You've got a gap here. You'd be looking at this gap would be your next reference. Filling the gap would be next. Okay, what else we got?
Okay. Okay, somebody's asking about the foundation e-course. They said, I understand the prerequisite, especially due to changes in the course since your books were written, but the foundation e-course itself would be quite old. How would that help me?
It covers the basics, and it's got,
It reflects a lot of the changes that Jim has made since the time the books were there, so it is very relevant.
yeah, it was done
And
well after the books were written. Okay.
yes. Okay. Um, okay, the launch of the current rally happened in the overnight early morning 7 a.m. period of the 7th of February, when the market rallied from the settle of the previous day. Does that make it weak even though it was outside regular trading hours?
No, don't get too exacting on this. Now, what I will say is this rally today, early today, that took the market to new highs, it is unusual. Doesn't mean it can't happen. It is unusual that a new meaningful high occurs in the electronic market. I've seen this happen and I've seen it last for a few weeks, but it's one thing what we call carrying information forward. You have a much better chance of the high being lasting if it happened during regular trading hours where all trading forces were available. Okay, what else?
Another clarification I just wanted to make, because that person asked about the Foundation e-course, that was released in 2018, just so that you know. And we do occasionally add lessons to our e-courses. And so that is something that we have done both for our Foundation e-course and our Advanced Nuances, just so that you understand that those are more up to date. Okay. Um, Okay, yesterday the C and D period high and low were exactly the same. When something like this happens, how do you approach it?
It was a non-trend day. And I mean, it makes some sense. Here's the market at that 5,000 level. And there's a lot of, as I said earlier, a lot of people know that's where the high risk is. So the market, they couldn't buy it, they couldn't sell it in there because that's the really high risk area. You have less risk buying it on a breakout. You have less risk selling it if you get some substantial movement to the downside. Your real risk is right at right at that 5,000 level. And a lot of people just say, experienced traders say, wait a minute, the risk reward being in here doesn't make sense. A lot of short-term traders, momentum, oh my golly, FOMO, I don't want to miss the breakout in there. So you've got smaller traders trading mechanically around that 5,000 level. You've got smarter traders, larger traders saying, I don't know what happens. This is probably what I call a go, no go level. It's either a failed breakout or a meaningful breakout. But I'm better. Remember what I said about the smarter money, trading money. There's more risk buying it yesterday at say, 50.11 on the futures than there is at buying it 50.20 today if it breaks out to the upside, or 50. This is the high risk area. And a lot of times you just take a breath, step back, and let's see, learn how to listen to the market. What I just got done, the chapter I just got done writing in the book talks about our relationship with the market. Sometimes it's like our romantic relationships with our partner. You just don't understand me. You never listen to me. And a lot of times that's what happens to traders. There's information in the market. You have to know how to listen to it, and you now have to know how to understand it. If not, it's going to be a very treacherous and not a very good lasting relationship. Okay, Jen, another question.
Okay, could the 5,000 level be a trap to headlining in the news and to attract buyers?
No, I don't think so. I mean, yeah, it could trap a lot of people either way. And that's why, I don't think it deliberately goes there. It's just something that the market, that the forces of the market. Remember, momentum traders, that's the easiest strategy to follow. And that's what they're doing. The price goes up and it's not irrational for short-term traders. So I think that's just what happened. And markets go to usually very visible, identifiable levels. And that is a very visible level. So I don't think, I get it. If you don't do it right, it can trap you. But I don't think it's deliberately designed as a trap. Okay, what else?
Okay, so we had several people that ask if your charts are in 1 tick or 2 tick increments. They are in 2 tick increments. And then somebody was asked.
I just enjoy the 2 ticks gives me personally a better perspective of what's going on in the market. It helps me dial down my emotions. I'm like anybody else. You've got to control your emotions so they don't run over you. Okay.
Okay. What was the first thing that you recognized in 1974 and 1987 that signaled the top was in? What was the first thing you recognized in 1974 and 1987?
No, it's not. It's not the first thing. It's not. It's a process, and the process was that the market kept thinning out. The participation kept narrowing, going to fewer and fewer names. That's what it was like. I say in the Nifty 50. We were there when it was following. IBM was basically the only stock holding the market up at the end. When you got to 87, it was a few high flyers. Where are we right now? We've got a few stocks. Then it's narrowed. What's really carrying the market has continually narrowed. That's the danger. All right. Final question.
I just wanted to acknowledge this person. I just wanted to tell whoever's interested or has doubts about Jim's mentorship, without him, I would be long gone by now. I really appreciate his teaching, and it's worth it. Thank you for that. Okay, there's another question here. What does Jim mean by unchanged value? He's looking at overlapping value or settle price to gauge if the value is unchanged.
No, here's the value right here. Okay. So I'm looking, is the value higher than yesterday, lower than yesterday, overlapping to lower, overlapping to higher? Okay. So we're going to stay right here if we're going to open in a minute. So the gap has been, if we open right here, the gap has been closed in there. Now, keep in mind, this reference is weak. Yesterday's reference, you had no excess down here. And you're getting more pressure on interest rates again. So we're going to open sharply. It looks like the gap is not going to be there. So now our focus immediately shifts to developing value. Did value develop higher today, unchanged, overlapping to lower, or lower? Value, price is an advertising mechanism. Value will help you keep a clearer perspective. And within value, you always want to monitor the point of control. All right, let me say thank you very much. I wish you well on what should be a pretty interesting day. Bye now.
Thank you, everybody. And if you have any questions, don't hesitate to contact us at dalton@jimdaltontrading.com or at the number at the bottom of our website. Thank you so much. Have a great weekend.